So Zynga, for those who don't know, Zynga is a social game developing company. So they develop games like City Wheel, Farmville, Mafia Wars, and so forth. And they get money from sale of virtual goods in games. So you pay some virtual credits to them, and you get some kind of an item that you otherwise wouldn't have been able to obtain. They of course have in-game advertising as well. So it is predicted to go public on 15th of December with a valuation of 10 billion versus 14 billion as it was previously predicted in summer of June. Just to compare, Electronic Arts that makes such games as FIFA, right? Their market cap is $7.6 billion, and Blizzard that makes the most popular multiplayer online role-play game, World of Warcraft, is valued at 14.2 billion. Right? Let's take a look at the revenues of Zynga. They're not as explosive as Facebook's revenues, of course, just for the reason of not everybody on Facebook playing those games. And they're not essentially, they don't have the monopoly in the online game market. But what's interesting here is just pay attention to December, it's 828 million of revenues. The next chart shows how many of those revenues are coming from in-game sales. Not from in-game advertising, but from the sales of in-game items. So it's roughly speaking, more than 90% of their revenues are coming from selling goods in the game, right? And this is the number of active users here. So those three charts are straightly connected with one another. So as far as you can see, the monthly number of active users is fluctuating and it stays the same over the period of time. So no more people are coming over. So knowing this, what do you think is the biggest challenge?
Expanding their customer base. Because if, like, as we discussed earlier, say it looks like it's going to be difficult for Facebook to grow as it has done with its customer base, and if that accounts for 90% of their revenue, then they're in a bit of trouble if that's the case.
Well,
so
yeah,
it
is indeed a true answer, but there is a more specific reason behind it. Their biggest challenge is making those people pay. When you go to play a game on Facebook, you're not really looking for paying for it, right? So what happens now is, if you could just go back to the number of users. So out of those 227 million users monthly, only 1% pays for it. And this 1%, 5% pays for it. And 1% makes half of their revenues. So if you think about it, this 1% can be interested in this game at one point of their life. And then the next day, they just drop this game and move to something else. So they don't have this, well, they have the loyal customer base, but it is not as solid as probably they would like it to be. So the biggest challenge is making sure that that 1% pays for the items in the game, and it keeps increasing, which it is not at the moment. Right, moving on. Groupon. I hope everybody heard about Groupon, which is a coupon website where one could come and buy some goods for a discount price. So they're essentially market making, if they're speaking in the financial terms, which means that they connect buyers and sellers. So the sellers are the enterprises that want to sell their products, and the buyers are just us basically, and they take the fraction of the price as their revenue. They had the target of raising 30 billion for an IPO, and what happened was it dropped it to 12.7, and they went public with that price on 3rd of November. There is of course a reason for this, and we'll just look at it later. This is the dynamics of the share price. So it started at the 3rd of November at $20 a share. It went up, well, because you can't really short sell during the first week because there were no people to borrow shares from. And then it traded for a few days at a constant price and fell down on 21st. So the reason for this, there is a clear reason for this that led to these consequences, that led to them being valued less than they predicted actually. And this is the problem with their business model. Can anybody tell what the problem with their business model is?
It's very easy to replicate. Anybody can come.
Spot on. So as soon as the Groupon appeared, and as soon as they started to get those massive revenues, everybody said, well, hang on, can't we do the same? Can't we just, hire the sales force, call the retailers, and connect the buyers and sellers in the same manner? They are not offering anything unique apart from their connections with the sellers and the uniqueness of their deals. But that's subjective, of course. So as soon as they started growing rapidly, the competition arose from Google and from Amazon. So that's one of the main reasons for the valuation going down and share price plummeting. So because of this, they are not having a healthy cash flow. They are struggling, and their actual net income is negative. So the reason for the bad performance is competition from Google and Amazon, and of course large marketing expenses associated with the former. Because in order to have this strong position in the market, they have to reinvest a lot of cash flow into getting new partners and getting their share back. So basically what happened when Google Offers went live, Groupon had 50% market share. And what they were offering the sellers was, we sell your product, but we don't give you the money that we gained from the product for 60 days. And only after 60 days, we are going to give your money back. And during that period of time, we reinvested the money into their operations. And that's what kept their cash flow going. Google Offers came in and said, well, we can offer better terms. We can offer you 80% back in 4 days. Well, that's a massive improvement on 60 days without anything. So people just started to migrate to Google Offers, sellers. So just after Google Offers was launched, Groupon went from 50% market share to 25%. And that's why they had to reinvest a lot of their cash flow into establishing those contracts over and over again. So finally we came to LinkedIn. The three main sources of revenue are hiring solutions, marketing solutions, and premium subscriptions. So the first two are connected with enterprises. When an enterprise comes with LinkedIn and says, we would like to pay you so you would find somebody suitable for us, or we would market our company on your website so that people would come to us and send a message so we would hire somebody. And the latter one comes in relation to the user base. So you come in there and you pay for the premium account. Their IPO was priced at $40 a share on 19th of May. Since then, so let's take a look at the revenue. As far as you can see, revenue is growing steadily. So there are no anomalies in here. So they're getting some money from somebody. Apparently, they're increasing their subscription number, right? So just as in the Facebook's case, everything should have been fine if not for this. So if you look at the graph, this is how their share price evolved. What happened between July and August, so you see a spike in there. Basically, people were optimistic about that, and their user base was growing. But then analysts started to expect they're going to actually lose money, and they're going to post a loss of 4 cents a share. So it went down, and then they posted a profit of 4 cents a share, which is still for this kind of big company, but still, the stock went up. Between October and November, it started to go down again, because analysts were expecting a loss of 6 cents a share. They posted a loss of 2 cents a share, which is better, but it is still a loss for this kind of valued company with this huge kind of valuation. 2 cents a share loss is clearly not appropriate at this time. But the reason for this is they reinvested a lot of their cash into marketing solutions, just as in Groupon's case. But they are looking much healthier than the Groupon. I would like to finish it off with a video that basically wraps everything up.
Dig into valuation a little bit deeper, all right? Because we ran the numbers, and here you go. Cost a little more. The question is whether Facebook is really worth it. All right, so if you pay $100 billion, if that's the valuation for Facebook, it would imply it's trading at a price to sales of 23 times. For a little perspective, LinkedIn, 8 times. Groupon, 6 times. Google, 5 times. eBay, 4 times. Apple, ready for this? 3 times. 3 times versus 23 times. Would you rather own Facebook or Apple? You start to get the picture. Pandora, 1 times. Price to sales, that's the issue. We spoke to Bob Tangent, or I should say Bob Rice over at Tangent Capital. He said, you know, Adam, it's worth something. It's probably worth about 10 or 12 times, but he said, why would I pay 23 times for a business generating $4 billion in revenues if a lot of those revenues are coming from games? He said, just because people are interacting on Facebook doesn't mean that they're actually dollars that are being interchanged on Facebook. That's the problem, says Bob Rice over Tangent. And then you say, well, all right, so let's say I do buy the IPO of Facebook when it ultimately comes public. Well, look at them now. If you look at compare where they're trading now versus the first day that they went public, HomeAway down 37%, LinkedIn down 39%, Groupon down 40%, Pandora down 41%. Isn't it curious, by the way, that they're all down about 40%? That's the issue, Lisa. It may be an exciting company. We may all be part of Facebook, but as Bob points out, if you have trouble actually quantifying where the numbers are going to come from, you have trouble understanding where the growth is, and therefore you have trouble paying 23 times earnings. And as you look at some of these other companies, they've traded down too.